Hello, everyone, and welcome. I'm excited to kick off today's session with our presentation on accounting basics. Today, we'll explore the fundamentals of accounting and do so in just a few minutes. On this first slide, you'll see the title, Accounting Basics, along with a subtitle highlighting that will cover the essentials quickly and clearly. Over the course of this presentation, we'll look at key concepts, important terminology, and some practical tips to get you started. So, let's dive in and make accounting simple and understandable for everyone. Welcome. In this part of the presentation, we're going to set the stage for understanding the fundamentals of accounting. We'll start by exploring the different types of accounts, which are the building blocks of financial information. Then, we'll delve into the key components like assets, liabilities, and equity. These are essential for understanding a company's financial position. After that, we'll look at income and expenses, which show how a business earns and spends money. Finally, we'll discuss the main objectives of accounting, helping us see why this discipline is so vital for effective business management. Throughout this session, keep in mind that these concepts are interconnected. They all work together to give us a clear picture of a company's financial health. So, let's get started on understanding these core ideas that form the foundation of accounting. Now, let's take a closer look at the different types of accounts you'll encounter in accounting. There are 5 major categories we need to understand. First up, assets. These are resources owned by a business that have economic value, like cash, inventory, or equipment. Think of them as what the business owns that can help generate revenue. Next, we have liabilities. These are obligations or debts the business owes to others, such as loans or accounts payable. They represent what the company is responsible for settling in the future. Moving on, owner's equity. This reflects the owner's claim on the assets after all liabilities have been deducted. It's essentially the net worth of the business from the owner's perspective. Then there's income or revenue. This is the money earned from the core operations of the business, like sales or service income. It's what fuels the growth and sustainability of the business. Lastly, expenses. These are the costs incurred to run the business, such as salaries, rent, or utilities. Expenses are what reduce income and impact profitability. Understanding these 5 account types is crucial because they form the foundation of how we record, analyze, and interpret financial information. They connect directly to our overall goal of making informed financial decisions and ensuring the business stays healthy. Now, let's take a look at what we mean by assets. Essentially, assets are resources that a business owns and that have value. These are the things the company controls that can be used to generate future economic benefits. For example, cash is an asset because it's available for spending or investment. Inventory is another key asset. Think of the products a company has ready to sell. Equipment also falls into this category. It includes things like machinery, computers, or vehicles that help the business operate smoothly. Understanding assets is crucial because they form the foundation of a company's financial health. They represent what the business owns outright, and knowing about these resources helps us assess the company's stability and capacity for growth. Throughout this presentation, we'll see how managing assets effectively is vital for making informed financial decisions. Now, let's talk about liabilities. Essentially, liabilities are the debts or obligations that a business owes to others. They are the financial responsibilities that the company has to settle in the future. Think of liabilities as the promises the business makes to pay back money or provide services later on. Some common examples include loans, which are borrowed funds that need to be repaid over time, and accounts payable, which are amounts the business owes to suppliers for goods or services it has already received but not yet paid for. Understanding liabilities is crucial because they impact the company's financial health. They show what the business owes and help us gauge its ability to meet those obligations. In the context of our overall financial picture, liabilities are just one side of the equation. Along with assets, they help us understand the company's net worth. Keep in mind, managing liabilities effectively is key to maintaining financial stability and supporting growth. Now, let's take a look at owner's equity. This refers to the owner's investment in the business. Essentially, the money and resources that the owner has put into the company to get it started and keep it running. It's a key part of understanding the financial health of a business because it shows how much the owner has invested directly. Owner's equity includes two main components. First, we have capital contributions, which are the initial and any additional amounts the owner invests. Think of this as the owner's direct contribution to help the business grow. The second component is retained earnings. These are the profits that the business has earned over time and decided to keep rather than distribute as dividends. Retained earnings grow the owner's equity because they represent accumulated earnings that have been reinvested back into the company. Connecting this to our overall theme, owner's equity reflects the owner's stake or claim in the business. It's a crucial indicator of the stability and growth potential of the company because it shows both the initial investments and the accumulated earnings over time. Understanding owner's equity helps us see not just how much money the owner has put in, but also how well the business has performed in generating profits that contribute to its value. Now, let's move on to slide 7, where we focus on income or revenue. This is essentially the money earned from the core operations of a business. It's the top line on the income statement, and it gives us a clear picture of how well the business is performing financially. Revenue is generated through various means, but the most common are product sales and service income. When a company sells a product, the money received from those sales counts as revenue. Similarly, if a business provides a service, the income from those services is also classified as revenue. It's important to understand that revenue reflects the company's ability to generate sales, which is fundamental to its success. And by analyzing revenue over time, we can gauge growth trends, market demand, and overall business health. Throughout our presentation, we've emphasized the importance of understanding financial statements, and revenue is a key piece of that puzzle. It ties directly into how the business earns its income and sets the stage for assessing profitability and operational efficiency. Now, let's take a closer look at expenses. Expenses are essentially the costs that a business incurs in order to generate revenue. They are the outflows of resources that happen as part of running the business daily. For example, rent is a common expense. It's what we pay to lease our physical space. Wages or salaries are another major expense, covering the payments made to employees who help keep the business running smoothly. Utilities like electricity, water, and internet are also part of our expenses because they are necessary to support our operations. Understanding expenses is crucial because they directly impact our profitability. The more effectively we manage and control these costs, the better our chances of achieving a healthy profit margin. Throughout this presentation, we've seen how expenses fit into the bigger picture of financial management. They are a key piece of the puzzle in understanding how a business generates profit and sustains itself over time. Now, let's take a closer look at the main objectives of accounting. First, recording transactions is fundamental. This means systematically documenting every financial event that affects a business, from sales to expenses. It's the backbone of accurate financial information. Next, we classify and report this data. This involves organizing transactions into categories and preparing reports that give us a clear picture of the company's financial health. Think of it as turning raw data into meaningful insights. And finally, accounting supports decision-making. By providing reliable and timely information, it helps business owners and managers make informed choices about investments, operations, or even future strategies. So, in essence, these objectives work together to ensure that accounting not only keeps track of the numbers, but also helps guide smarter business decisions, tying back to our overarching goal of understanding how accounting fuels business success. Now, let's wrap up with a quick summary of what we've covered. First, we looked at the 5 main types of accounts that businesses use. These include assets, liabilities, equity, revenue, and expenses. Each of these accounts serves a specific purpose and helps organize financial information clearly. Next, we discussed what each of these accounts really means, like how assets are what a business owns, liabilities are what it owes, and so on. Understanding these definitions is key to grasping how financial statements are built and interpreted. Finally, I want to highlight why accounting truly matters. It's not just about keeping records, it's about making informed decisions, staying compliant, and ensuring the business stays healthy and transparent. All of these basics are the foundation for good financial management. They help businesses stay organized, make sense of their numbers, and plan for the future. When you understand these core concepts, you're better equipped to navigate the financial side of any business confidently. Thank you so much for sticking with me through this presentation. I really appreciate your time and attention. If you have any questions or want to dive deeper into any of the topics we discussed, please don't hesitate to reach out. We're here to help clarify and support your understanding. And remember, if you found this helpful, please like the video, leave a comment with your thoughts or experiences, and subscribe so you don't miss out on future content. Your engagement helps us grow and continue sharing valuable insights. Thanks again for watching, and I look forward to connecting with you soon.